My name is Marshall Dahneke, operating partner since 2020 with Gridiron Capital, which is based in Connecticut, but I live in Provo. I'm moderating today because, frankly, I probably look more like you guys than the people up on the stage. I may be with private equity now, but I've really been a business operator. I was CEO of a company called Performance Health. Prior to that, I was GM at Steris Corporation and Hillrom, all in medical devices, med tech, and life science kinds of businesses. So that's what brought me here. And let's go across the stage here, starting with Ben, then Doug, then Mike. They'll each do some intros, and we'll jump into it.
Great. Thanks, Marshall. And thank you for having us. We're excited to be here. My name is Ben Capell, Managing Director at Peterson Ventures. So Peterson Ventures is the seed and venture capital arm of Peterson Partners. So Peterson Partners is a platform, multi-strategy investment firm. We've got about $1.5 billion in assets under management, lower middle market private equity fund, search fund, and then a seed stage venture fund. So I know we're talking a little bit about Series B and after, but we'll also be talking today about our experience investing in the seed stage and how to think about that, the early rounds of financing as well.
I'm Doug Dieter. I'm a partner at Ares Management. We're about a $306 billion asset manager. We are pretty well known as one of the largest private lenders in the world. We've been one of the top, if not the top, healthcare private lenders in the United States. I co-lead a group called Ares Specialty Healthcare, mostly focused on biopharma, med tech tools, and diagnostics. We'll do anything from $25 million of financing up to $2 billion, depending upon the need of the company, stage of the company, and what they're looking at doing.
And I'm Mike Smith with D.A. Davidson, a managing director. I lead their Salt Lake office. D.A. Davidson is a little over almost 1,500 employees. We do public offerings, secondary offerings, sell side and buy side, mergers and acquisitions, as well as capital raising. So kind of through all the stages a company may go through.
Awesome. Thank you, gentlemen. Let's dive right in here. Let me make sure I get the wording right. So to begin today, let's start with what? Meaning, what are the relevant types and sources of capital for a business owner looking to scale? And we'll just go across the stage, starting with you, Ben. If you could give your synopsis of, Capital 101, starting with you with equity, and then we'll hit debt and structure. And for each, please indicate types of capital, pros and cons, and other key considerations.
Yeah, absolutely, Marshall. So happy to chat about maybe that first round of funding and how to think about it. So we've been investing. I've been at Peterson for 12 years. We're investing out of our fourth fund. So we've probably been a part of making 100 or so investments over that time period, mostly in the seed stage. And I think as you get into that first round of funding, thinking about taking on an equity partner, an equity partner comes on your cap table. So that is dilutive financing from that perspective. And so that's important, right? That's equity in your business, and thinking through the trade-off of bringing on partners that are going to take equity, going to be on your cap table. A really important part of the process is figuring out the right partner that can be helpful for your business. So it's a couple things that as we talked about this before, that I could share that might be helpful. So one of the things that we've seen in the seed stage in these early rounds of financing is that if you have you want to do the trade-off of, I'm giving up equity, but am I bringing on a partner that's going to add more value than the equity that I'm diluting? And that's ultimately the trade you want to feel comfortable with. And one of the things we've noticed over the years is if you bring on an institutional partner early in the seed stage, bringing on more than one institutional partner into your seed round can actually help a tremendous amount. So we've looked at the data on this. So a lot of times referred to as syndication. If you bring on more than one institutional partner, a lot of time you'll almost 2x as likely to go on and raise a Series A round. And if you think about it, and a lot of you are probably in this situation, you're looking to raise capital. You've got some people around the table who have a lot of passion and energy for a problem you're trying to solve. You got unique insight into how to solve that problem. Otherwise, you wouldn't be doing this. But you are limited in resources. That is one of your biggest constraints at this point in time. And so capital is a resource, but also networks. So additional networks, additional resources. And so having that additional capital and resources from institutional investors can really be helpful. And then if you can also layer that on with a group of angel investors that has real value, that may have operating experience, that may have the ability to introduce you to customers or key talent, that can be a really valuable way of structuring that first round of financing. Because then you have institutional investors who this is their job, this is what they do all day, every day, and they're going to reserve capital to invest in your business down the road. And that's really important because as often as we want to believe that growth is linear, the reality is it's usually not. And so having partners at the table who can provide some additional capital as you work through some things in your business is really valuable. Then if you can layer on angel investors that have deep expertise in the space that you're in, we've just found that to be a really great way to structure that early round of funding and accomplishes a lot for the not just the founders, and because it's going to provide value hopefully beyond the dilution that you decide to take on. So those are my thoughts.
What I like about this panel, by the way, is that Ben and I are kind of at opposite ends of the spectrum.
Opposite ends of the spectrum.
You're able to see both sides of the world. So, I'm coming from mostly the debt world and debt financing, although we are writing and we are looking at sizable pref checks, preferred equity checks, doing private converts in businesses, which are less dilutive. And then we're writing sizable loans and doing revolvers and ABLs. And there is, I think you were kind of alluding to it. There is also a when, which I know we're going to get to a little bit here, But I think the key you were making a point on was that it's important that a company is appropriately capitalized with the right capital in it, and it's not just when, but it's also obviously you're saying who. So what we focus on are those key areas. Also within this spectrum of what is different types of debt. So there are a lot of very early stage companies, true venture stage companies that are getting venture debt as effectively bridge capital on a less dilutive basis than going with equity. Typically that's a much more structured type of debt financing. There can be ranging from $5 million to typically $25 million, although in the last 3 years, I'd say the venture lending world has also scaled up in size, and maybe they're creeping towards the $50 million size for companies. Then there's the more advanced stage where companies have commercial assets. And by the way, this could also be for services. And this doesn't have to just be for biopharma and medtech. It can be for tools diagnostics that have launched. You got a 510K approval in something or something along those lines and launching where you need launch capital. That can also be traditional debt financed. I was talking to someone today who's doing intellectual property lending as well. So there's another what, which I don't do that. It's a very specialized market. But there's obviously a lot of people encroaching on IP out there, and you can lend against that type of asset. And then there's also, I mentioned ABL revolvers. Many of you have launched companies. You've got purchase orders and things like that, and you can actually get capital and push that capital forward to just borrow capital in the short run to finance your growth versus having that working capital burn. That type of capital exists in substantial size as well.
And I guess the perspective that I'll lend to this first question, because I don't, if you will, really have an axe into whether you do equity or debt. Either way is there. What I would, though, like to frankly mention is the structure of the instrument you take on and thinking through that. Maybe to put a finer point on it, because I've had a couple examples of a company we sold last year and a transaction we're doing right now is, if you will, bells and whistles that may come with an equity round or a debt round. And what I have found, frankly, kind of doing this for 25 years, is that often more bells and whistles, so to speak, come with an instrument when there's a real difference in valuation expectations, i.e. what the equity partner believes your company is worth and what you believe your company is worth. And oftentimes, to kind of bridge that gap, sometimes you do things that aren't what I'd call natural or you ought to do when you look back. And with that, maybe to kind of think about that is when you talk about a preferred equity instrument, well, is that a participating preferred, i.e. do they get their money out first and then participate on a common basis? Is that 1 times or 2 times participating? Does it have accrued dividend? Or is their security look a lot like the common security you hold? And oftentimes, what drives those differences can be that you think your business is worth so much, yet the market's telling you it's worth less. And so you take on more of a structured instrument to kind of bridge that. And then when you get to the end, and I kind of feel like I'm the end, when we go to sell the business, those early decisions have a real impact on how proceeds are distributed and how people feel about it. And so I know it's an awkward thing to say, but if anything, think about, try not to do that, if you will. Try and think about what the value is. Try and, if you will, get a good sense of what others think your value is. And to the degree you can, try and raise capital, and it can go with debt as well, that is a lot like the equity you hold. And so that you're really aligned in terms of your motivations going forward. And I think you'll not only have a better process in growing the business, but it will really pay dividends when you go to exit that business.
Awesome. Thank you. And by the way, it's obvious, right? But these aren't either or questions. Ultimately, as you're successful, you'll end up with a combination of capital sources, both equity and debt.
Hey, Marshall, can I just say something on that real quick? I think especially as you're thinking about early stage financing. So one of the things that we try to do is have a cap table that is in terms that are as vanilla as possible, because as soon as you introduce those terms, they will persist through multiple rounds of funding.
And grow. They get worse. They don't get better.
Simplicity is key.
Yeah, simplicity is key. And to the extent you're having these conversations early on with some investors, and sometimes you'll have angel investors who have maybe some real estate background or something, and they have a different thought process on this. And just remind them that they're, especially early investors are a lot closer to common than they are to whatever the Series D or E investor is that is coming in later that might benefit the most from those terms. And so it's really to everybody's benefit. And I think for a while, actually, in the Utah market here, that was not as well perceived. And so it's been important. And you don't see some of those terms very much anymore here in Utah, which is good. The participating preferred has sort of seen its way out, which I think is really important. But just as you're negotiating, you're having those conversations, that's an important key. These early investors are much closer to common than they are to the Series D or E, and they actually want the terms to be really generic and sort of down the fairway.
Thank you. Let's move along to the next question. We started with what, and you'll see that these questions all kind of blend together anyway. But question number 2 is really more time-based, or when. How might a business owner think about the capital structure of their company at various stages of maturity? And you've already kind of hinted at this. What might they be considering at each stage, starting at the seed stage, but then mid to late stage, if you could dive in there, Doug? And obviously Mike has already claimed the last, the exit, the taking chips off the table, the change of control kind of stage. Ben?
Yeah, so early stages, I think a lot of times the capital that you have access to in the early stages is going to be equity financing, because there isn't a structure or there's not enough inside of the business in terms of assets to actually go out and find somebody who will loan to the business to get debt. Now, as we've talked about, there is venture debt in the early stages, but typically what venture debt providers are doing is they're really underwriting the equity that is on your cap table. So they're only coming in because you raise equity capital, and then they're providing an additional buffer of capital for the business. But what they're really doing is, who did you raise from and how much did you raise? And then they're going to determine how much they provide in venture debt financing based on those two things. So they're going to want to understand your business and the opportunity, but they're really relying on the equity financing to make that determination. Now, that said, I think especially in this sector, more than other sectors, there is opportunity for non-dilutive financing through grants and other things. So that's really going to be based on your particular business and the opportunity that you're pursuing. But as you grow the business, you do open up opportunities for different types of financing. So at Peterson, we've got the Seed Stage Venture Fund, which I manage, and my colleague Taylor, who's here. But as companies grow, they get to kind of 10 million or more in revenue. If they're generating cash flow, our private equity firm might come in and provide some financing. So once you get to that at different levels of revenue, 10 million, 5 million, 10 million, you open up different avenues of financing, which could be equity, could be debt. But early stages, thinking about equity or non-dilutive financing through grants is probably your main two options.
And when you think about this panel, theoretically there should be someone sitting between us who's a venture lender, and then someone to my left who would be private equity. If you really wanted to have the full continuum here. So to your point, on any given day, I have a conversation with a company, CFO or CEO, around what is equity and what is debt, and what is the appropriate time to do so. I had one today, which was, you're smarter off going off with equity right now, not the right time. So, from a venture side, I agree with you wholeheartedly that, and also I believe companies need to have sophisticated boards to understand venture and when that is appropriate time, because you are putting a lien on all assets, and you
Venture
ultimately
debt.
have to take them out. And it's very short duration type of capital that's borrowed. What I do is a lot longer duration, and so there are more. I'm more focused on companies with a commercial asset or with a viable operating business, and that's not directly investing in preclinical assets, clinical trials and so forth. The fine line in between equity and debt, in my mind, is having a commercial asset, being commercial in some way, because prior to that, you're taking regulatory risk, launch risk. Well, launch risk after you're approved is something that we will do, because then it's an approved asset, and the market will have value for that. So the line between equity and debt, in my view, is just an approval or commercial. So obviously, if you're a services-based company, I think we just heard an acute care company here, right? That's services-based. I mean, that's a commercial business. But if you're a med tech company, tools diagnostics company, so forth, if you're not approved yet with at least one asset with a pipeline behind it, you're probably not ideally set up for a traditional lender to be coming in to helping finance you. Understand also the line between equity and debt is, debt carries its own risks, because you are, again, putting a lien on assets, and there's a lot more there's sophistication to some of these structures, as you well know. It also really matters who you're borrowing capital from. You want to be working with groups that understand that there are always bumps in the road with regard to businesses, and there always are. You need to be working with people that take a longer-term approach to your business, that actually understand your business, understand who you are and what you're doing in your products. There's a lot of companies that are just lending, to your point, to equity. And the other thing is, there are firms that, and I think Ares is actually viewed as one of the top partners to the private equity community globally, and we are really working to introduce ourselves to non-sponsored companies, non-private equity-based companies, VC-backed companies that are mid to later stage businesses, where they recognize that we've got capital that has the entire continuum, where we're not just coming to you and saying we're going to give you capital and you're going to take us out, right? We're trying to provide capital that's continuum based, where it may be higher cost of capital because you're earlier in your business, but we can refinance ourselves out and grow with you over time and lower your cost of capital as you grow your business, as you advance your pipeline, as your commercial launch continues. And the third point I'd make is, in a world where payers are increasingly becoming more sophisticated, more concentrated, as you all know, scale is important. And so you need to be working with someone who can deploy capital and scale with you and help you in-license, help you acquire, to add to your bag for Salesforce, to create density in particular markets. And so that's really important, where you're not working with someone who's going to give you $25, $50 million and can't grow to $300, $400, $500 million as you grow over time. And that's something that I think my firm is very focused on, and working with company over a long period of time and demonstrating true partnership in finance. Hope that's helpful.
Now maybe to kind of talk about the exit, I would like to talk about kind of philosophically a couple points. One, why this cap structure is so critical is what you never want to have to do is have to sell your business or have to exit. I mean, that's maybe it's the obvious, but as you think about the equity, the debt, how these pieces come into play, it is all about flexibility in a lot of ways, because growth is not linear, and you want to be able to have, be able to make those choices around the exit. The other point I really wanted to make, and I think is a little counterintuitive, but as you think about exit someday in your business, try not to think of that as a time when you've taken the business as far as you can take it. That's really not when you should exit a business. Exiting a business, think about it more when you couldn't be more excited about the prospects, when you can see great growth, when even though it may make sense to exit the business, you would be thrilled to reinvest in the next owner of that business. Those are the times when there's true runway, when you see excitement, is the time that is actually best to exit a business. Because that'll come through in how you approach potential suitors, whether they be a strategic buyer, whether they be a private equity buyer, whether they be a public offering. They'll see all that. If you've taken it as far as you can take it and you've run out of answers, it's a tough sale process. That's just not a situation you really want to be in. But we often don't think that way. We think, okay, I'm exiting, so I'm done. Instead of, no, there's a lot of, if you will, meat left on the bone. I'm going to maximize valuation now. I would love to be a part of the next stage, even though it may be in a minor role. And that's philosophically how I would encourage you to think about that phase of this life cycle.
Can I just add to your point? The phrase we always use is companies want to be bought, not sold, right? And to your point on the exit, when you have to, we say the same thing in raising capital. You want to raise capital when you can, not when you have to, because that will always be the most expensive cost of capital.
Thank you. And I'm going to chime in here as moderator and say I'm going to slide in just philosophically, okay. Slide in between the two of you representing private equity. I totally agree with everything you said, Mike, but let me take the edge off and say exit is such a harsh, permanent word. And so private equity loves to partner with founders. And there's a lot, like Gridiron Capital, there's firms out there that really go and seek founders and business owners. They don't want to just buy the business, they want to buy the team. They want to buy the brand. Invest, sponsor, support. And there's different variations, different flavors, right? They can take a minority interest, take a backseat and be supportive. I think a lot of private equity looks to take a controlling interest and take a majority position. But for all the reasons you guys were talking about before of alignment and skin in the game, they want that founder and that management team to roll over and reinvest a portion of those proceeds. I rarely use the term exit. I always use the term of taking chips off the table, or the preferred term of getting another bite at the apple, right? And this kind of transcends into the next topic, but lining up, maybe you own a lesser percent of something that you're going to grow into something substantially more. Just one quick example, and we can all kind of tell fish tales. But I know Gridiron Capital acquired a Northeast Ohio-based company, and I'll use round numbers. Let's say they paid $100 million for it. and they're still have a controlling interest, and they're the majority owner, and looking at avenues for them to exit their investment. The founder, if he took $100 million paycheck at the front end and reinvested a portion of that, has already pocketed another couple $100 million over just from dividend recaps and such during this holding period, and will therefore earn several $100 million more. So, started in that case $100 million, and he's going to be looking at being a billionaire. That's that second bite of the apple. That's that staying with the business and having plenty of gas in the tank, right? A lot of runway.
That's well said.
So think of taking chips off the table. If you want to exit the business and pursue other life priorities, that's absolutely an option. But if
I'll just add one more comment to that. I'm Dan from 3M Healthcare, but also sitting in between those two seats in the sense of we have corporate venture capital and we also do acquisitions. And so, as you know, there are companies and corporations out there where this fits very closely with the strategy, and we will either take a minority investment or take a small stake and partner with you. Back to your point, right? Or there's a specific cause we can help you. You can
perfect.
help us.
And one plug, and never do any of these without an iBanker. let me say it this way: private equity loves acquiring companies without investment bankers being involved. Private equity would never exit an investment without an investment banker involved, and there's a reason for that. So make sure you're well represented. The final question that we have established for ourselves, and let me serve notice, if we have a few minutes, we'd love to pass the mic and let you guys ask this group some questions as well. We already got into this, but the question of who, right? We talked about what and when. Now the question of who, and Ben addressed this in his earlier comments. Why might the source of new capital matter? Why is selecting the right partner important? What's the difference between money and smart money?
Yeah, so I there's a couple of things here. I think thinking about it in two ways. One is, does the investor have knowledge about the space that you are operating in? I think that's really critical. And there's times where we've said, hey, look, we really like the business, we like this management team, but we are not sure we can add the value that you need as an investor in this particular instance. We think there's probably a better investor out there for you. And I think that's probably the reverse of that is true, is that there are investors who are going to have knowledge and expertise about the sector that you are operating in. I think that's important. The second piece is finding investors that you are excited to partner with. And that's so important because, when you're starting a business and you're excited about it, but what you don't often realize is this is a 7, 10, 15-year journey. There are entrepreneurs that I have a 12-year relationship with. We've been through a couple companies together and ups and downs and challenges along the way. But it's a relationship you're going to have for a long time. And so those two things are important. And there are times, what I would say is there might be a time where you'll prioritize the second because you've got the first. You've got some investors who provide that industry value and expertise, and you want that. And so even if an investor may not have that, but you can see and you can tell that there's a real partnership there that will be valuable to you over the life of your business, that's another thing to consider. But I think across those two elements, have industry expertise and knowledge, because you don't want to go to I've heard entrepreneurs say this, I don't want to go to my board meeting and be the smartest person about my sector in the room every time. I don't want to spend time educating my board all the time. You want somebody who comes in with knowledge, but then you also want somebody that you can partner with. And one of the things that we talk to entrepreneurs about is when you have something that's on your mind, who do you think about calling? And if you think about calling us, we're doing a good job. Whether that's a problem or that's a good thing or it's a problem. And if we're doing our job as an investor, we should come to mind. And I think that's what you want to find. And that takes extra work. That takes spending time with the investors outside of just doing the work, looking at financials, talking about the business, the sector, the competition. That's some relationship building, but it's something you'll be really, really, sometimes it gets overlooked in the transactional nature, but it's something you'll be really glad of when you can find it.
Yeah, I think I touched a little bit on it, which is just, the who is and I think you've touched it pretty well, which is, can they add value? Can they help you think strategically? Can they sit in your board meetings or in the background as just a board observer and advise the CEO? One of the things that is, and by the way, the other thing is when you want to look at the duration of the capital of the people that you're working with, right? Are they short-term capital? Are they short-term minded? Or do they take the long-term approach? That really matters because, like I said, there are bumps in the road, and when bumps in the road happen is when you really find out who the financial partner is, and do they extend things? Do they grow the capital base, improve your balance sheet? There are so many investors out there that don't have that. It's not in their mandate. The idea of being a partner isn't top of mind. Look, I'm fortunate that I'm actually at a firm that has that entire spectrum and has a lot of permanent capital, and we're focused on truly partnering. And by the way, you'll hear the word partner, and it means a lot of different things, as you know. And so you need to really dig into that. I'd say also, there's a lot of money out there. There just is. And particularly today, in the last few years, there's been a lot of capital. I think you mentioned a little bit about being top of mind. I wholeheartedly agree. The other question is, can you bring resources to the table? A lot of financial teams that work for CEOs are totally strapped right now, and need help on modeling and board presentation materials, thinking about how to cut costs and how to manage the balance sheet. Are they highly constructive? I'm in countless calls where I'm trying to make introductions to CEOs where they may be trying to build out a network, find a research partner on something, right? And so to your point, they need to know the business, they need to know who they're working with, and can they bring additional resources to the table? Just as a little plug, we have a $30 billion private equity arm as well, and there are many different types of private equity partners that are, intently very much involved, are more providing capital, just trying to provide support and resources. And I think a key question is kind of what kind of financial sponsor are you is really probably should be your first question, and you'll get a pretty clear answer by asking that question.
I've got Ben. I think Ben's point's really important about personality, and then I guess I said it in my first comment, I'll say it again. There are things that are just more important than valuation. And who you're with, it makes all the difference in the world. I think part of how to determine that is for you as operators to ask very direct questions. What is that financial partner's vision? What are their milestones? What are their expectations? When would their off-ramp be? When would they want to take money off? You really need to have those conversations on the front end and see if you really line up both from a personality, getting along, how you communicate with one another, and what those expectations are. As you two were speaking a couple years ago, I sold a business that was majority owned by private equity, where the CEO and the they hated each other. I didn't feel like I was selling a business. I felt like I was a divorce attorney, and they wouldn't even send their projections to each other. They'd send it to me, and then I would mitigate. And it was just awful. And I laugh. I called it the Bachelorette transaction because I think we did 14 different roadshow meetings with different private equity because I just promised the CEO we're going to get it right this time. And now, 4 years later, they've tripled the size of the business, and the CEO and management love the private equity, and it couldn't be better. So it really matters to take the time on the front end and really make sure you're aligned in what you're out to do, because there will be bumps in the road. I mean, things are going to, like we all know it, things are going to go wrong. And hopefully you come out of that as the best of friends, whatever the situation is. And then the only other thing I'd add that's maybe kind of different than all this is and maybe this is expressed in that they get and can add value, but brand name does matter. I mean, whether, sometimes you wish it doesn't matter as much, but, there's a couple great brands on the stage with me right now in terms of the firms they represent. And Gridiron's another really good brand name. And you've got to be thoughtful, too, and put that into the equation that maybe, Ben, you can speak about this, but who those angels were. If they have the right brand, they attract more money like you. If you have that right venture arm, they track debt. Debt has a real opinion about who you're in bed with, so to speak, on the equity side. And you've got to kind of think ahead of each of those decisions will affect the next round, if you will.
And I would just say, you should ask for references. So do calls with other CEOs that have worked with the firm.
And make calls that weren't provided as references. Dig a little deeper. I mean, I think you guys absolutely nailed it. I was involved in buying a number of companies, but selling, transitioning to multiple new private equity sponsors. And understand this, in any transaction or any investment, people are going to be looking at you and scrutinizing you and looking at all your detail. You know what? You owe it to yourself to do the same with them. While they're evaluating you, you need to evaluate them and take advantage of every opportunity. Ask the questions, but assess every interaction, and then look at the whole and say, do I want to spend the next 5 to 10 years having these kinds of conversations with these kinds of personalities under these dynamics? If the answer is I'm not sure, you probably have an issue there.